Welcome, welcome, welcome. Happy Tuesday morning. All right. What I need you guys to do is work on the do now right now. If it wasn't completed, okay, so I can tell you right now, only 5 of you completed the do now. All right. I need this done. This is what we use to jumpstart our conversation this morning. All right. This is part of your corporate debt assignment that is due this week. I told you guys yesterday, make sure you check your do nows. You should have checked this do now last night, not this morning. So if you're waiting to do it this morning, you're already behind. All right, your do nows will be posted in advance to the class. They need to be done the night before. This is how I'll take attendance. If you don't complete it, you'll be marked out. All right, just so you guys are aware. I'll give you guys about 3 more minutes to complete the do now. Once again, I'll give you guys about 3 more minutes to complete the do now. Okay. Welcome to Tuesday. All right. I'd love to see some of your responses. Drop them right here in the chat window so everybody can see. You can copy paste it and just fill in the blank. Does anybody have the first blank they'd like to fill in for us? All right, so Frank, an MBS is an asset-backed security. The asset here is a mortgage, correct? All right, Frank did the whole thing. Let's just read through Frank. A mortgage-backed security. MBS is a bundle of home loans. So you guys just threw it into Google, huh? The loans are pooled together and sold as bonds. And they pay interest payments and the principal. Good. What's that mean now? So now you found the explanation online. Now tell me what it actually means. So I'll let you guys unmute yourselves. Give me 1 second. All right, you can now unmute yourself. Frank, you went first. So I'd love to hear what you have to say about this, Frank. Explain it in layman's terms.
I guess it means like investors are sort of buying the debt off people when they are buying homes. So, and banks use this, like when banks loan out money, they're basically losing money and they're expecting the consumer to pay it back somehow. So instead of waiting like 30 years for them to pay it back, they can just sell this chance to investors, and that way like they'll actually get the money right now instead of like waiting 30 years to get it.
Okay, a fair explanation. You seem to grasp it for yourself. Anybody else? I only got Brian, Tyler, and Frank who responded. I assume everybody else has similar research done. Anybody have a, let's go. Does anyone have a, oh, who's that?
Newman.
Newman, what's up?
Oh, I was going to say that like sometimes when people aren't able to successfully pay off their mortgages and banks take the homes or whatever type of property it is as collateral, usually like what they do is they usually sell off like the houses and stuff like that in the form of bonds and whatnot. So other banks will now accumulate that debt and take on the houses. The house will usually become foreclosed and the bank will resell the house.
So it's not necessarily about foreclosures. It's about the mortgage and loan in general. So what happens?
Oh, okay.
So what is a bank's job? What is their goal as a bank? What is their goal?
To lend out money in order to make profit.
Okay, so to make money, right? To earn a profit. So in order to earn a profit, they buy and sell a wide range of assets. Mm-hmm. This asset that we're discussing, mortgage-backed securities, is just that. The asset is the mortgage. So this is what caused the crisis in 2008. Okay, mortgage-backed securities. What happened was they were selling houses to people who could not afford those houses.
Yeah.
Right. So teachers making 60 grand a year were living in $800,000 houses. It didn't make sense. The banks knew they would not be able to afford those homes. They still sold them anyway. What is the risk if you do that?
Mark off losses when people can't pay it back.
Right. So inevitably, at some point, some people can't pay it back. What happens if you're a bank and you give out enough loans to people that they cannot pay back?
Go bankrupt.
Say it again.
People are going.
You can go bankrupt.
Who can go bankrupt?
The bank.
The bank.
Why would you say the bank will go bankrupt?
Because if too many people are defaulting on their loans, they were supposed to get back the payments, but then now they can't, and people can't pay it back, so then the bank is losing more money depending on how much loan they give out.
Correct. So what do you, if the bank knows that they're selling bad mortgages that people can't pay back, do you think a bank is really going to allow themselves to lose money?
No.
Nope, they're going to use the mortgage and sell it off as a bond to other banks, right, and other financial institutions.
They are going to take all of these. Let me share a whiteboard. So you've got second. Okay. You guys can see my whiteboard?
Yeah.
All right, good. So you've got a bunch of loans, and here's one house, right? There's another. And these are just the size of the loan, right? The mortgage. So let's say you're a bank and you've got all of these outstanding loans or mortgages, for this case in point, mortgage-backed securities. So we're only talking about mortgages. Okay, so MBS is not about credit card debt. Okay, it's not about other forms of debt. It's not corporate debt. What kind of debt is this?
Mortgage.
Mortgages. That's it.
Mortgage.
Strictly mortgages. All right. No credit cards. No other forms of bonds. No municipal city bonds. Nothing. We are strictly looking at mortgages. So Citibank decides that they're going to lend all of these people money. So there's Newman, Adrian, Tyler, Frank, Vincent, Williams got the big loan with the big house on the hill, Ashley, Brian, Leland, Adrian, Rafi's got the little one because he's never home, so he's the smart one here. All right. What they realize is, you know what, we can make more money, right? We can make more money if we take all of these loans and bundle them right into one bond that looks like this. Okay, so all of these mortgage-backed securities, all of these mortgages, right, equate to one bond that they are now selling to investors. Would you buy this? This is your MBS, mortgage-backed security. These are your mortgages. Write this in your notebook. Make sure you guys have this. All right? Does this make sense?
Yeah.
Yeah.
All right. Would you, as an investor, buy a mortgage-backed security?
Depends on what's inside the package.
Yeah.
So that's the key. The key is what's inside the package. Very rarely do people look too deeply on what's inside the package. What do they look for?
The amount of,
The rating.
yeah,
Investors look for the rating and what?
yield.
There you go. They look for the rating and the yield. So the goal is, it's like a big house of cards, right? You give out all these mortgages, you sell all these mortgages, knowing that at some point, maybe they can't pay it back, but you're getting, every month, what are you getting from these people that have a house?
Yield.
Which is what? The yield is made up of two things.
Principal and
Interest.
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 The principal and the interest. Okay? So you're looking at the principal and the interest. What you hope is that you'll earn enough that you can buy it, hold it, get your interest, and before these people can't pay back their home, you sell it. Or that you sell it to someone else because the yield looks so good. So what happens if this person defaults on their loan?
Then the investor can't get the money from the MBS
Right. So
as much.
right. So this person defaults. This person cannot pay their debt. Right? They can no longer pay for their house. Unfortunate, it happens. Neither can this person. Neither can this person. These aren't big deals until you start getting more of them. Because if you only have 2 out of 5, that's 2 foreclosures. The bank can take over the house and then resell the house. Okay? But what happens if too many of these start foreclosing at once? No payments, no interest, no
Value
yield,
of
no yield.
the MBS goes down.
Say it again.
Value of the MBS goes down.
Say it one more time.
The value of the MBS goes down.
Yeah, so the value goes down, the yield goes down, and nobody wants to buy it. So now what happens to the bank? This bank now owns this bond, which is now worth, let's do it like this, is now worth significantly less. So they were
Aren't
getting,
banks the ones that sell
they were
MBS?
getting that big piece of the pie. Their piece of the pie just got cut by 35%. Does that make sense?
Yeah.
Yeah.
Therefore, the bank loses money,
So do the investors.
the investors lose money, and what happens to these people?
You lose a house.
You lose your house. Those are mortgage-backed securities. And banks, and they're basically what you can say is most banks' jobs is to find a way to generate money. You package debt and resell it to someone else because there's always a buyer. There's usually always a buyer that wants something. Somebody always wants that yield, right? You're chasing yield, right? Chasing it, like a dog after his tail. And sometimes you lose a lot of money.
Howard, I have a question.
You didn't do the research, or you thought that the economy was healthy enough that they would be able to pay off their loans and you would continue getting that high yield. But what happens if there's an economic slowdown, which would happen? One person can't pay off their loan, then another one, then another one, then another one, then another one. It becomes a domino effect. The whole house of cards falls down. Newman, what's your question? Hello?
Yeah, I'm here. The question I had was, in order to make the bond look somewhat attractive sometimes, like besides the yield, wouldn't banks put together also like some houses that they're pretty confident that people will pay off?
Yes.
Like, wouldn't just be like,
Right. So you have good mortgages and risky mortgages in there. But again, if you put more risky mortgages, the yield that you get is higher.
yeah,
So if investors want the yield, guess what? You'll give it to them. So yeah, this is good.
for risk.
What'd you say?
In compensation for risk.
Exactly. So, yeah, like you'll have, this one's, oh, that's not a good color. Let's go with that. So this is good. This one's 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 good. All the others are high risk. Yeah, these people with the green checks are paying back their mortgages and yield. But what they're paying back is smaller because they have a better credit score. So their interest rate is lower. So what they're paying back to the bank is smaller. So if you have somebody that wants a big yield and a good return on this MBS, you got to make sure you have some risky assets in here, because if you have a lower credit score, you have a higher interest rate payment, which means you'll provide a better yield to an investor.
Okay. And the good mortgages are never enough to offset the bad ones, correct?
No, I mean, we talked about bonds, right? So let's get rid of mortgage-backed securities then. So it's the same concept. Apple has a AAA rating. Apple gives you 1% per year on a bond. Tesla's a double B rating. Tesla gives you 10% a year on the bond. If you want a safe investment, you'll get 1% return. If you want a risky investment, you will take the 10% return, knowing that Tesla may or may not pay off this bond. Same exact situation. It can be risky or not. Most mortgage-backed securities, a lot of times, they'll be riskier. Because investors want the yield. And what you'll do is you'll package it and you'll put it in a bond. You'll make it look pretty, right? You'll talk about all these mortgages in Key West and in San Diego and, all these places. Oh, wow, this is the next hot spot. This is the next hot spot. This is the next hot spot. And you sell it to these investors that, look, all these hot spots are inside this MBS. and you sell them on it, and they buy it.
Is the reason why they don't sell individual mortgages and sell mortgage-backed securities instead is because they want to offload all this crap that they have?
Yes, so you want to get rid of the bad debt. You don't want to hold bad debt. If you can give it to someone else, you would definitely want to do that. So
that's why banks make MBSs?
Yes. So let's say
Gotcha.
this mortgage-backed security pays, let's go 15%, right? Well, I'm the bank. I'm actually going to tell you, I will sell you this for 13%. Well, guess what I'm still taking?
2%.
2%. So I have now given you my debt wrapped up in a mortgage-backed security. I still take 2%, and you're stuck holding the bad debt and the 13% return. So you get your 13%, I get 2%, but who has all the debt?
You do.
13%.
This person has all the debt.
The investor.
Right? So it's
So
15, I sell it, I get 15 from it, I give it to Newman for 13, I get 2%, so I'm happy. Newman holds all the debt, and if this goes belly up, Newman gets screwed.
So for the most part, banks are just always going to win if for some reason all of the debt is actually paid off, or most of it.
Well, not necessarily always, because it really depends. If you can't sell this, imagine you can't sell it.
Yeah, that's true.
So you
package it.
Right, you have to package it and make it look nice. But what happens is sometimes you have so much debt and people catch on. That's what happened in 2008. Lehman Brothers, they let Lehman Brothers go bankrupt. They had so much bad debt, the Fed could not bail them out. There was so much bad debt on their books. Nothing the government provided in terms of a bailout would save their business. So
Wow.
if you understand this, MBS, you will understand this concept. So that's the name of the movie, Too Big to Fail. So the question is, all these banks do all these risky, oh wait, hold on, you guys can't see it because I didn't switch. Give me a second, hold on. All right, you guys can see this now?
Mhm.
So this movie is all about mortgage-backed securities.
We watched that before.
This is about the banks being too powerful and giving bad loans and then packaging those bad loans to other investors and other banks and selling it to them. And then when the economy started to slow down and commercial real estate or your personal home couldn't make those payments,
Yeah.
and people started getting laid off, well, now you have a domino effect, right? Where you're not getting the yield and you're trying to sell the bad debt. Well, now you can't get rid of the bad debt because no one else wants to buy the bad debt. So your bank is holding all this bad debt. So you're foreclosing on houses to try to get some value, which means this person now has no house, or this business is closing because you gave them too high of an interest rate because you knew they didn't deserve this house because they couldn't afford it. And it just became a huge house of cards that all came down at once.
Wait, Mr. Power, so when you foreclose a house, does the bank get the house or do you get the house?
The bank.
No,
Bank.
the bank will take the house as collateral. Like it becomes theirs, and then they try to resell it to get their money back.
Why wouldn't you take it if it's your debt?
So, okay, so let me go back to this then. So you own, there we go. Let me move this over. So you own the mortgage-backed security, right? You own the bond. I still own the properties. I'm selling you this, right? I'm selling you this. I'm selling you the bond. But if they go bankrupt, the bank keeps this.
All right.
So, I mean, it can be a bit much to kind of get. But when you look at this, the key focus and takeaway here is if this person goes bankrupt, right, and this person goes bankrupt, and this person, right, whoever owns this bond is now not getting their money. So then they try to sell this bond to someone else who probably won't buy it.
It might be just me, but I don't think you're sharing your screen correctly, or it's frozen or something. I'm gonna try to rejoin the meeting.
No, hold on. It's
No. Yeah. Okay, now it's there.
Okay, is it there now?
Yeah.
Yep.
Yeah.
So this person who owns this MBS, when they realize that these people are not paying and they're defaulting, they will try to sell this mortgage-backed security to someone else. And then you just see who's the last one holding the, you know, it's like playing hot potato. Who's the last person holding it when all the cards fall down?
And sometimes they don't, because people finish off paying the debt, right?
Well, yeah, so this person could pay off their debt, and that's great. But if you're selling risky mortgage-backed securities, these people in red are not paying it back. And that's what started the economic recession in 07, 08, 09, because the banks were giving bad loans.
Mm-hmm.
So the premise of this entire movie, this one, Too Big to Fail, is that the banks are banks too big to let go out of business. That was the issue. Are banks too big to let go out of business? That's the risk. So I'll ask you guys, do you think in 07, 08, 09, the banks should have been bailed out? They knew what they were doing. They sold bad loans to people. They sold bad mortgage-backed securities to other investors. And then the banks went to the government and said, we're broke. We're laying off like 50% of our people. We have no money coming in. We need you to help us out. That's why the name of the movie is Too Big to Fail. Are the banks too big for the government to let go broke? And file bankruptcy?
I really think that the government shouldn't. I mean, it's a tough situation because it's not like a bailout where you want the banks to like necessarily be stable. It's more so due to the fact that so many consumers and everyday people get impacted if the banks don't get bailed out. So like that's the issue. But overall, I kind of lean more towards not bailing them out to kind of set a precedent that you shouldn't be doing risky business like this and just trying to basically throw off lots of bad debt that you have to try to make potential profit down the line. I think it's too risky and it can create a lot of bad issues. So I would lean more towards not bailing them out.
All right. Anybody else?
Well, I personally lean towards not bailing them out too, because like if they file for Chapter 11, all they do is their shareholders take over, and hopefully those shareholders can make better decisions.
Oh, so what happens if you let them go bankrupt? What happens if you let Goldman Sachs, because they had so much debt on their books that the debt was worth more than the value of the entire business?
Oh.
So that's the issue with some of these businesses. The debt they had was worth more than their entire business. So imagine Citibank being worth $30 billion and they had $40 billion worth of debt.
That's not sustainable.
That's
At
not
all.
sustainable. That is the issue. So there would be no shareholders. There would be nothing. And that's what happened to Lehman Brothers. If you owned Lehman stock, you got zero. They went to zero. The stock went to zero.
And then in the movie, like they're struggling trying to find like other banks and other financial institutions that will actually help them out after the government said that they wouldn't.
Correct. And that's the thing. So the government was looking to find a way to keep them afloat in order to try to prevent an economic collapse, I guess, so to speak. So, Adrian, what do you think?
I agree that
Hello?
Hold on.
So guys, I'm going to show you a chart. Can you guys see this?
No.
No.
Behind the too big to fail.
Behind the Chrome tab.
Hold up. You guys cannot see this stock chart right here?
No, we don't.
Now we can.
Yeah,
Now we
it's
can.
Now
up.
we do.
It's up.
Now we do.
Oh, okay. So I have a lag. Sorry. All right. So you guys can see this now, right?
Yeah.
Yeah.
Okay. This is the Lehman Brothers stock. This was Lehman Brothers. $70 a share, $80 a share, $90 a share. 2007, right here, is where things started to get iffy. And this is where the collapse was in late 2000 and early 2008 and went all the way to zero.
Howard, I still had to answer.
Huh?
I'm sorry. I had to leave the call by accident because you know those security people that they assigned to you to check in if they're good on you, they called. But I ended the call.
I have no idea what you're
Can I
talking
still
about.
answer? You know how like this was assigning people like to each individual to make sure that you're okay during the coronavirus?
No, I
If
have
they
no idea.
called, but I tried to hang up, but it already transferred. Well, the school is doing that. So
Okay,
can I still
whatever.
answer
Either
the
way,
question?
either way,
I didn't.
either way.
Yeah,
You guys are fine.
got it.
You guys are all fine.
Yeah.
This is the chart going to zero in 2008. The government let Lehman Brothers fail. They had to. They also did this. They also took companies with bad debt and check this out. They took companies with bad debt and they started merging them together with companies with good debt. So let's see if I can find you a couple banks that merged 2008. But so Bank of America acquired Countrywide Financial. Bank of America also bought Merrill Lynch for $50 billion. Citibank bought Morgan Stanley. Because what the government tried to do is they tried to find all these banks and say, okay, you buy this company because you're healthy and you're not healthy, and you buy this company because you have less debt and you can offset their debt. So that was the process. All right. That was the Fed and the Treasury Secretary trying to prevent all of these banks from failing. Any questions on that?
Doesn't that turn at least that sector or market into more of an oligopoly than just being more diverse with a bunch of companies?
Yeah, but the other option is what? If you didn't facilitate those mergers, what would happen?
Banks fail.
Banks fail.
Oh, no,
Too many bankruptcies. Too many bankruptcies. Could you afford to have all of these bankruptcies? That is the premise of this whole movie, guys. It's fascinating. That is the entire premise. Are the banks too large to fail? Which is why when you look at the current economic situation you're in now, it's very different. Now, there is quite a bit of corporate debt out there, but they also have a healthier balance sheet. All right?
But Howard.
Yes.
Knowing how crucial it is that banks are somewhat stable, why isn't there more intervention through the government throughout a bank's operations? Like, why does it always have to be, we trust you, but then when things go bad, that's when we're going to take a look?
Good. So the Dodd-Frank Act, which I'll pull up right now, Dodd-Frank, D-O-D-D, Frank Act, not the Franklin Act. Sorry, Frank. That act was signed in 2010, where the government the SEC and the government would try to get more transparency from a lot of these bigger banks. The banks also have to go through something called a stress test. All right. So they go through what's called it's basically a simulation. It's a stress test. The simulation is if there were an economic downturn, is your balance sheet healthy enough to withstand it? So yes, to a degree, there are things that the government has tried to do. But again, the entire country is built on economic growth. Economic growth is seen in the stock market. So their goal is that these companies can also continue to increase how much they're earning on the backs of the people paying their mortgages. That's what the mortgage-backed securities are. The bank's earning more on the back of people who can't afford to pay off their mortgages on their homes or commercial real estate. Now, if we look at this whole assignment that you guys will be working on is about debt, right? And I know it's not due till this week. Corporate debt, we've discussed. Facts about debt, we've discussed bonds and loans for the whole year. Defaulting on your loan. Can somebody give me an example of how you could personally default on your loan? Personally. Aaron. Hold on, I want to pick on Aaron. Aaron, are you there, or you just logged in to fake it so your face was on my screen? There you go. Aaron, give me some personal debt you could default on.
For myself?
Yeah, for yourself. What kind of debt could you default on?
Taking out loans from the bank.
For what? Would you take out a loan for?
If I wanted a car.
There you go. Defaulting would be you cannot, here's the key word, pay your debt holder, which might be Citibank or Visa or whoever, right? It could be, what else? Ashley. The best thing that could happen, you guys, I hate to say it this way, but you guys don't have prom, right? You're not going to prom this year. So you're $300 for the limo, you're $500 for your dress, you're $200 for your hair and nails. You're saving about $1,000. Well, if you're not working, how do you think you're going to pay for that? Ashley?
Yeah.
Huh?
I mean, you don't. If you default on your loan and then you go bankrupt.
Well, your parents get the loan.
So
no, he was talking about a credit card.
Right. So a credit card. So if you don't have cash, you would swipe your credit card. Get your dress for prom, get your hair done, get your nails done, pay for the limo, pay for the hotel wherever you guys stay that night, whatever you guys are doing. If you couldn't pay off that loan, you would be what's called defaulting. Defaulting just means you're missing payments on any debt you have. It could be on your mortgage, or it could be on your credit card. It could be on your student loan payments. All right, you could be defaulting on your payment to Netflix, and Netflix will tell your creditors who you pay through. You can default on anything that you owe money to. Make sense?
Yeah.
All that is missing a payment. So just be careful not to run up your credit card if you can't pay your bill. I don't need you guys defaulting. Defaulting will jack up your credit score. And jack up meaning drive it down. And then your next credit card statement is going to have a higher interest rate. Your next mortgage or your next loan is going to have a higher interest rate. Because you've proved that you are not what?
Credible.
Credible or reliable to pay off your debt. All right, so that's defaulting. Loans, leverage loans we discussed. A loan that is extended to companies that already have loans. Right, so you have a loan to build your business, and then what do? You take out another one to continue to build your business. And you hope, you guys can see my screen, right?
Yeah.
Yeah.
And you just hope that at some point you start making money. So LevFin, also known as LF or leveraged finance, is actually a part of investment banking. All right. They're responsible to advise companies on taking out those loans.
Wait, Power, is it only a leveraged loan if you take another loan from like the same financial institution?
No, a leveraged loan is you have loans outstanding and you take on more loans.
It doesn't have to be from like the same financial institution, right?
No, any loan. If you have a loan outstanding
Oh, okay.
and you owe another loan and you take out another loan. So let's say you have a loan on your business, $100,000 loan, and then you go to another bank and take out a $150,000 loan. You are leveraged. You took your second loan as a leveraged loan where you took out a second loan to help pay for the first loan.
Oh, okay.
And ready? Then you start going down and we start talking about collateralized loan obligations, which is those banks take all of your loans and your leveraged loans and they package those loans up with a yield. And then what do you think they do with those?
Give it to investors, people that are willing to take it.
You sell it to somebody else who's willing to take it. So you take all this debt that somebody else has, you package it up, you put a bow on it, and you say, anybody want this? Look how pretty this is. Look at your yield.
That's such a bad practice because you know that people are not smart and you're allowing banks who are smarter to make these decisions that can and most likely will impact a lot of people.
Hire smart. Hire smart. Make sure you have smarter people working for you. That's why this movie is funny. All right? Be first, be smarter, or cheat. So this movie, Margin Call, was this company had so much debt on their books, they realized that they had to offload it in 2008. Well, they decided to be first. They sold all of their debt to anyone that would buy it. And within the first 2 to 3 hours of the day, they sold most of it. Because then by the time the end of the day, all these other investment banks realized that they're liquidating their balance sheet. They're selling all this bad debt, wondering why. So their goal was you can be first, you can be smarter, or you can cheat. They said, we're not going to cheat. We're just going to be first. We're going to be the first company to sell all of our bad debt and get rid of it off our books. We don't want it. Let's get rid of it. So they were originally smarter, but then they realized that they had more debt than the value of the entire business. So what do? Sell the debt to someone else who's willing to buy it. That's this movie. So this is from the hedge fund point of view, like I was saying earlier, where they had all these mortgage-backed securities and they decided that they had to sell it first. This is from the banker point of view, where the banks had so many mortgage-backed securities, they had to sell it also, or go bankrupt, which happened to some, or merge because they couldn't live alone because they had so much bad debt. It's fascinating, guys, and scary, all wrapped in one. Xiaoyi, yeah, the movie links I put into the Discord. Actually, Tyler put them into the Discord. They should work. If they don't, you guys can comment in there, and I'll see if I can find them for you. I looked on Amazon and Netflix. I can't find them anywhere. So they're not on any of those major places. Okay. Good. We're done at 9:45, right?
Yeah.
Yes.
Well, yeah, 9:45, 9:50. Yeah.
Perfect. Finish up your corporate debt. Tomorrow we'll just do Q&A if you guys need some tutoring on corporate debt. Thursday we're going to talk about activity 2 and activity 1. And we'll finalize credit default swaps and collateralized loan obligations. If you know mortgage-backed securities, then CLOs and CDSs are going to be super easy for you. Good?
Sounds good. Yeah, sounds good.
Good.
Guys, have a wonderful day. I'll see you soon.
You too, Mr. Powell.
All right. Bye, Mr. Power. Have a good day.
The do now is posted. The do now is posted for Thursday. So make sure you guys do that. I'll see you guys later.
Okay.
Is Newman still here?
I will post my video.
Hey, Newman. I just want to add on to what you were saying earlier. Dude, banks don't care. They just want to make money. They don't care if people are stupid. They rather have people that are stupid because then they can sell it.
I completely understand that, but now here's the thing though. It's one thing if it's a business where it's like, okay, you're screwing over yourself. But with banks, it becomes a big issue when you're screwing over
The
yourselves and you're screwing
point of
over.
banks is to screw over other people.
Yup.
Yeah, but when
That's
you
all
screw
banks
over,
do. They can only make
but when you
money
screw,
with money. They have to
but
screw
when
over other people.
but when you screw over too many people, right? Then what happens is the government needs to get involved. So like now I'm saying that in this country, the governments basically act on laissez-faire, like let everything be, let businesses and like let banks do whatever they have to do.
What?
But now when you yes, like that's basically like the
Bro,
whole
what are
business
you
principle that this
talking?
country acts on.
Excuse you? You know how much regulation we have? Nani? What?
Not
Dun, dun, dun.
no, obviously we do have regulations, but I'm saying that the government allows many businesses to rack up ridiculous amounts of debts. They allow banks to do
Dude,
lots of
debt
terrible practices
drives the economy.
You're right.
Debt drives the
when it's healthy.
economy.
You build
Without
your
debt,
When
businesses.
it's
our
Healthy
economy
or
would be
not,
nothing.
debt drives the economy no matter what.
You build your businesses
But
based on debt. So I'll tell you guys a quick story. My father and mother had a florist shop. They maxed out so many credit cards and they weren't legit profitable, like they made income. They weren't profitable until they sold their business. They worked on debt their entire lives. And that's how a lot of businesses operate, on debt. And for banks, they have to make money on debt. All they do is take your money and loan it out. That's their whole business model.
And it works.
Well, what's
it
the
works
alternative?
most of the time. It works most of the time.
Most of the
It
time.
only doesn't work if there's something new that the government doesn't know about, right? And CDOs screwed up everything for that, because like that wasn't a thing. Like, old regulators.
No, but
I
here,
don't know what the hell that
but
is.
with what we're talking about, you're giving out ridiculous amounts of loans to people that you know beyond a reasonable doubt this individual will not be able to pay it off.
Correct.
That's
Right?
perfect.
So you're putting yourself. That's not perfect. You're putting yourself
It
in a bad
destroys
because
Destroys
ideally,
your balance sheet, though.
I am so
Exactly.
okay with that.
no, because you as a
I think
bank, yes, you want to
subprime
make money.
subprime loans have high yields, right? If you're going to sell off the debt anyways, it makes sense.
But here's what I'm saying though, as a bank, ideally, wouldn't you want to give off loans that okay, there's a pretty
Hell
good
no,
chance
dude.
that
I
this
know you're
person's
trying
going
to
to be able
say
to pay it
hell
off.
no. No, screw that. No, you don't want people who pays it off. You want people who give you high yields. You want people who are in the subprime category. They give you like 25%, I think. No,
But here's the
that's
thing
ridiculous.
though, it's okay if you're able to make this nice package that someone will actually buy. But now if someone, I know Power was saying that more times than not, someone's obviously going to get the bond. But now if you can't, if this happens to many banks where people are not going to take this bond, then you're screwed. Because the fact that you wanted to act on a business model that screws over other people for you to make money, now when people are getting a little bit smarter, or when your competitors are doing the same exact thing, realizing that, hey, we need to package up all these bad debt and give it off as bonds. When people aren't buying these bonds, then you're screwed.
You know what they
And
do
then
with
guess
those terrible debts? If they don't sell, they just package it with other shit that doesn't sell and then resell that. It's amazing.
It's true. That's
You just keep repackaging it.
Honestly, I think there should just become a point where you shouldn't have more debt than your whole company's value. Because if you're at a point where your company's value is in the billions, and then you have debt that's more than that, you shouldn't be allowed to be bailed out at all.
Okay, to be fair,
Exactly.
yes, that's definitely
Because
true.
that's just
that's why we
poor
have fractional
financing,
rule,
and
right?
that just sets a precedent for the future that
Exactly.
that companies can take out all of this debt, and they'll still be saved by the government. Who cares?
That's what I'm saying. I think if the government is going to give these independence, these businesses to do what they do in banks, there needs to be some type of accountability. Because what we were just talking about.
Okay, well, the government's gambling too. It's really a gamble with the government. If they bail out these companies,
a bad gamble.
It's not a bad gamble because you're driving the economy.
Are bad gambles.
It is only a bad gamble if you're wrong. If you're right, it's a great gamble. That's the issue. Is that they hope that they're right and they hope that they can make enough and sell enough of these bad loans, make enough money, and then sell the debt to somebody else.
Also, not just that, if the government bails you out, the taxpayer's paying for it, and eventually it's going to come back to them. So it's kind of like you're pricing it in, kind of.
That's also the issue. You're using taxpayer dollars.
No,
right,
it's perfect. You're pricing it in. It's a perfect economy, the way it works. It's supposed to crash. You're supposed to bail it out. It's a dead economy. That's how it works.
Guys,
I think
you want me to just leave this on and let you guys talk?
No, then we'll probably talk on the Discord.
No, go ahead.
Yeah, sure.
I'll let you guys talk. I'm gonna go make coffee because I gotta make coffee for my next class. You guys can stay and talk.
I was gonna make a voice. I was gonna make a voice chat so we could just move there.
Well, no,
honestly, Discord's kind of better.
Well, I
have a question.
Yeah, but the thing is, I can post this, and the rest of your peers can hear the discussion. So that's the cool part.
That is true.
Oh yeah.
I don't want that.
No, that's good. It's good for educational purposes to see different.
Come on, how many people do you guys think are having these conversations right now? People in the banking industry, not your peers. So let your peers hear your discussion. See if they can grasp it.
And then Power, also, when are we going to start the commentary on the movies, on each movie, like on the Discord?
When are we gonna do what?
Like have commentary on the movies and on what we found.
So Tyler, do you want to make me a channel for each of those 4 movies, and we can discuss each movie separately if people have a question on it?
Okay, yeah.
All right.
So delete that. Yeah. So working on it now.
All right, guys. I'm actually gonna shut this down because I gotta let this video load and then drop it on YouTube before I have Lux come in a half hour. So I'll talk to you guys later.
Wait, before you go, do you guys, Newman and William, do you want me to make a call or whatever on the server so you guys can talk? Okay.
Well,
It'll be in general.
Okay, why not?
Later, guys.
I have nothing else to do. Bye.
See you, Power.
I mean, it's true. I mean,
Later.
I have no other classes.
All right,
Bye.
later.